Welcome to my channel. I'm the cover call guy, and this video is about high income ETFs with little to no NAV decay. This video was put together because one, there's comments left on my videos discussing about the restructuring and realignment of the portfolios for a downturn or maybe a more severe correction. And then on my previous videos, I've been talking about how you guys should be start looking at your portfolio to see if you guys are actually holding solid cover call ETFs. So I've just put a list together. This is not all cover call ETFs. This is just some high income ETFs with little to no NAV decay. So if you own it, let me know how it's been treating you. If it's on your watch list or you just recently bought it, let me know. Let me know how you feel about it. Um, so this is just a list. I don't have it all, like every single one. I just put, a few together and to give you an idea of what would be a solid high income ETF with little to no NAV decay that does well in pretty much all round market. So let's get started. But before we get started, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. Now, with that out the way, let's get started on today's video. I'll try to make it quick. I'll try to make it simple. All right. So the new generation of high-income ETFs, as we know, the landscape of income-focused equity investing have undergone a paradigm uh, shift. Traditional Gen 1 cover call strategies and Gen 1, Gen 2, Gen 3, or my labels, they are not actual financial terms. I've made that up just so I know, to make it easier for people to understand that are new to cover call ETFs. One, welcome to my channel. And two, these are Gen 1, Gen 2, Gen 3. It's just, generational one cover call ETFs. They came out the earliest. They were the first ones. Gen 2 was, a year and a half, 2 years ago, and Gen 3 is very, very recent, about a year, maybe a little over a year. They're the latest, greatest cover call ETFs right now. So Gen 1 ETFs, while offering high yields, expose a critical structural flaw, right? Systematic erosion of NAV, net asset value. Just think of it as your stock price. In exchange for income, investors sacrifice upside participation, leading to capital depletion that offset distribution. So basically, what solves this is some Gen 2 and some Gen 3, right? High income ETFs from innovators like NEOS, JPMorgan, and Goldman Sachs. So we're gonna find out how Gen 2 and Gen 3 kind of solve this, right? There's gonna be some active management, tax efficient structures to solve this NAV decay equation, right? So this is just gonna be a presentation about how to preserve your capital and grow your capital, right? We want our NAV to grow. So let's get started. The first one we're going to talk about is the tax efficient architects, NEOS Investment. They have been doing great. They have been doing excellent, amazing team, amazing ETFs, right? They have revolutionized the space by prioritizing after-tax total return, right? So they utilize Section 1256 index options, which offer a significant tax advantage over traditional equity options, right? They're creating a tax alpha that boosts realizable income, right? So this is a primary defense against NAV decay, as less of a distribution is lost to taxes. So you can see here the 1256 tax advantage, unlike options on individual stocks or standard ETFs, taxed at a short-term gains. Section 12 are taxed at a favorable blended rate regardless of holdings. So 60% long-term, 40% short-term. And then NEOS core income yields. By applying this tax-efficient strategy to different indexes, NEOS harvests high double-digit yields from U.S. large caps, tech, real estate, and international markets. So here are some: SPY SP 500. The yield is about 11.2%. QQI with the NASDAQ with the yield about 11.5%. IYRL, I believe, is real estate with a yield about 10.8%. And NIHI International, which is about almost 10%. So you can see here they have very, very good yields. Um, and of course here SPY and QQI. Let's see here before we get SPY and QQI. These would be the core engines. These funds, SP 500 and NASDAQ, use out of the money calls, allowing NAV to rise during bull markets. This structure combined with tax loss harvesting protects the principal base from erosion. And then we have IYRL. I think it's L, maybe I. Is it all caps? I forgot about all caps. That okay. It's with all of these with NEOs, right? This is the real estate ETF, the real estate harvester, applies the NEOs framework to volatile REIT sectors, extracting double-digit yields from an asset class that typically yields 3 to 4% by monetizing its interest rate sensitivity. And then we have NIHI, International Opportunity, unlocks volatility risk premiums of international markets, right, using 1256 contracts, providing a rare tax advantage way to access foreign yield. So I think these are one of the 4 best from NEOs that you can buy right now. Of course, you can also buy their hedge funds, not hedge funds, their hedge ETFs, or their coming up their boost yield ETFs that should be coming out soon. Those are going to be great in a very, very strong bull market. So you might want to hold off on those right now. And then we have the defensive pillars, right? JPMorgan, right? JPMorgan created the quote unquote the gold standard. I would say these are Gen 2, Gen 2.5, right? For defensive income by focusing on lowering beta and volatility. These funds are designed as stabilizers to preserve capital during drawdowns, making them an ideal bond replacement for equity investors. And we just do here a JEPI versus JEPQ risk and reward profile. As you can see here, let's just take away and do JEPI, right? JEPI is very, very volatility suppression, very high at 10. The yield is great and at a 9. And then we have upside capture as a 4. You know, they're not gonna really pump up in stock price because they're more of a defensive ETF. So we want these as a core for being a rock, right? If you think your portfolio is gonna swing up and down a lot, you can have these in your portfolio to try to stabilize it. Right, this is JEPI, the defense, and then we call JEPQ, the growth income. Right now, the yield is much, not yield, sorry. The growth capture is much higher at an 8. The yield is maxed out at a 10, and volatility is suppression is at a 6, so it's much lower than JEPI. Tax efficiency is about the same, and growth focus is much higher. So you can see here, we'll put them both together. As you can see the difference, they kind of balance each other out. And then we have the dynamic managers, right? These are more of the institutional managers for, I would say, the Goldman Sachs, right? These funds reject static rules using active signals to adjust their strategy. This flexibility is key to minimizing the capped upside risk that causes NAV decay in bull markets, right? Goldman Sachs GPIQ, it uses a dynamic override. What that just means is that it toggles its call options coverage based on the proprietary signals, letting the ETF run when the market rallies and harvesting more premiums when volatility strikes. So you can see here, they use a 25 to 75% rule. So the market rally signal, lower coverage, right, captures upside. When the volatility spikes, increase coverage, harvest premiums. So you see they use a very, very unique strategy that you're not going to see in NEOS or JPMorgan. And then we have from Amplify, QDevo. I just name it the tactical sniper. And what I just mean by that is QDevo is growth first and then income, right? So they focus on growth first and then income. That avoids the systematic drag of legacy funds by leaving 70 to 80% of the portfolio uncovered, only writing calls tactically on specific positions to add a yield kicker. So that is also what makes them unique. And then we have the daily reset innovators, right, from ProShares, iSpy. iSpy solves the vintage risk of monthly options. Legacy funds get capped early in a strong rally and miss out on substantial gains. By selling daily calls, iSet resets its cap every single morning at 9:30 a.m. Eastern Time, allowing it to participate far more effectively in strong trending bull markets and aggressively preventing NAV drag. Now, keyword here is aggressive bull market. Uh, so this is just a daily reset with monthly cap and a bull run, right? So we have to see how they perform in a downturn. So this is more of your um, aggressive bull run ETF. Wow, right here, 2, 3, and amplified. Oh damn, I didn't put amplify as 4. Well, amplify should be 4. So 2, 3, 4 would be more of your solid core in terms of a downturn market protector, and then this would be your super aggressive, um, uh, let it run type of ETF. And then number 1 would be more of your let it run and kind of choppy sideways markets. So here we see a very, very balanced portfolio outlook, right? We don't want to have all your portfolio leaning on one side or too much on the other side. We want it to stray a little bit in the middle while having some options to go left and right. So hopefully you guys are liking the pick so far. I'm trying, as you can see from this, the picks I have, I'm trying to lean in always. I'm trying to protect my portfolio, whether it shoots up, shoots down, or stays flat. That is my strategy. That is my mindset behind the portfolio I built. And then we just have the summary of everything I've picked. Um, there is no single best fund, right? There's only specialization. Each of these Generation 2 and 3 fund provides a structural defense against NAV decay, allowing an investor to build a resilient all-weather income portfolio, right? The key is to combine them based on your market outlooks. So I want as you can see here, the best market, bull flat, flat bear, tech bull, choppy market, strong trending bull, growth rally, volatile, and changing. So I want to be able to protect my portfolio in any direction it goes, right? So as you can see here, my verdict for maximum safety, JEPI, QQH, SPY H. For maximum growth, QDevo, I SPY, JEPQ. For maximum tax-adjusted yields, SPY QQI, YRI, NIHI. For institutional active, GPIQ and GPIX, right? And then this is something I just really kind of put together on what I think the next Gen 4 is cover call ETF is going to kind of turn into. This is just a very, very wild guess. So I think the future is going to have algorithmic overrides, just using deep learning networks to predict volatility and analyze unstructured data like earning calls to dynamically adjust option rating, maximizing the premium harvest only when it's overpriced. So I think a lot of that is going to start using AI. Yes, once AI gets that good, they're going to start handling, instead of a fund manager, I think the AI will start handling these cover call ETFs, and that could be a very good thing because it can also lower the expense ratio, right? That means you keep more of your money. And I think they're going to start possibly in the future. We don't know. Section 1256 expansion. I think it's only going to get better for investors. It always does. Typically, hedge funds has money to sway Congress. For those American like me, Congress has to do a lot of tax laws and stuff like that. So I think we're in a good position. And then I think personalized ETF 2.0. And what I just mean by that is I think in the future we're going to get a lot of options to really allow us to pick and choose our income overlay, right? Direct indexing platforms will allow investors to toggle their income overlay, like 70% monthly, 30% daily, and combine stock level tax losses harvesting with index level options and income for near zero tax liability. So I think that's the next evolution of these ETFs. I think, I'm not sure, but I think this is going to be the new era. And then just smart international, using AI to actively rotate global sectors, like buy Japanese, sell European. I think AI is going to start doing that for the ETFs while overlaying, 1256, to be at least the highest yield while the best tax after tax. And that's my presentation. That's the end of it. I hope you guys liked it. I try to make it short and simple. but this is what I would pick. This is how I would build my portfolio. This is how I'm actually building my portfolio right now. So um, if you agree, let me know. If you disagree, let me know. I always appreciate you guys leaving comments and telling me if it was a great video and you want more of it. If it was a bad video and I missed something, and then I appreciate all the comments. I take no offense to anything. I try my best to learn, and hey, maybe I missed a few things, and I could have changed a few things here and there. So let me know. Also, let me know if the mic is good, the volume. I know the mic wasn't good, and I've been messing around with the settings. So if this is good, I'll keep it like this. If not, let me know. Thanks for watching, guys. Subscribe, comment, like. I appreciate all y'all. Thank you. Catch you guys on the next.